Good morning and welcome to the Transformation Agenda Finance Under Pressure. My name's Erin Braun. I'm the West Coast correspondent for The Economist, so I write about politics and policy all across the American West. I'm very happy that you could all be here with us this morning and that you braved West Side traffic to be here. That is truly impressive, and so I want to thank you for that. Today, we're going to be taking a look at the ways in which technology is revolutionizing financial services. We'll start with a fireside chat. This will be just kind of a short introduction focused on the challenges that come with regulating technology and fintech in particular. Then I'll ask our panelists to join us on stage for a longer discussion so they can share their perspectives on the opportunities and the risks to firms and investors and customers as this ecosystem of banks and fintechs and big tech firms continues to evolve. Towards the end of each session, we'll open it up to Q&A, so I hope you'll be thinking of questions as we go. Before we begin, I would definitely like to start by thanking our sponsor, the Bahrain Economic Development Board, for making this event possible and for bringing all of us together today. So thank you so much. I'm really excited to get started. And I'd like to invite up Mitchell Lee to start. He's the Chief Risk and Compliance Officer at Synctera, and we're going to kick things off with a little fireside chat about regulation. Now, I thought before we dive in, I was hoping you could give the audience a little bit of an idea of what you do at Synctera and a little bit of your background.
Sure, yeah. So Synctera is a startup, Series A company in the fintech space. And what we do is we bridge banks with non-banks to offer banking products. We're a technology stack that sits in between. Think of us as a ledger and a risk and compliance tool. And the idea is it allows banks to expand their ability to distribute some of their products outside of their geographic constraints. And it allows companies such as fintechs to offer banking products by working with a chartered institution. So that's what I do today, Chief Risk and Compliance Officer. So all things risk and compliance with both banks and fintechs. And then prior to that, I was at the Federal Reserve, so I headed up the fintech group out of the San Francisco Fed. We worked on policy matters, supervisory matters, everything from crypto and stable coins to fintech lending and some of the things in my space as well. And I've been a regulator for quite a while, don't hold that against me, but I focused on really large banks. So the four-letter word CCAR, for those of you that might have been involved in that, that's stress testing, enterprise risk topics, data governance topics as well. So a whole range of different issues that I've tackled. And then prior to that, I was also a consultant for a while. And I tell people that often I joke about this, but my first client was Lehman Brothers. So got the opportunity and the punishment of seeing the before and after of sort of the global financial crisis during that time.
That's really helpful. Thank you for laying all of that out. Now, I sort of want to start with the million-dollar question. I hope that's okay. But how can regulators strike a balance between, safeguarding the financial system and also not stifling innovation?
Yeah, that's a great question and a very pertinent one these days. I'd say that there's sort of a fundamental kind of conundrum that I think regulators and policymakers are facing in this space, right? Which is, if you think about it in the US, we've got somewhere along 3,000, 4,000 banks and credit unions. And I think that's gone down from 20,000 once upon a time, right? And I think what you're starting to see is more and more consolidation because there's a recognition that many of these small banks have to figure out other ways to generate revenue and profitability. And so there's this kind of two worlds that regulators are starting to see, right? One is a world where you've got a lot of banks, they're doing lots of innovation. The size of them is smaller, and so that gives them maybe a bit of an advantage there. And it means that there's also chances of failure and chances of risk that they have to take, right? And I think of innovation, the definition of it is you're taking risk. And so that means that that's one variation of the world. And I think the other variation of the world is one where there's very few banks, and maybe they're much more diversified, and they are much larger, The regulation, the macroprudential kind of requirements, capital and liquidity can be much higher for those institutions. And it means that maybe there's more stability. But the impact of that is that you might have less innovation, and you might have customer segments and populations that are less economical for those banks, and therefore don't get kind of the benefits of innovation, right? And I think that's the area where a lot of policy and regulators are starting to try to figure out as far as new guidance, new regulations. And I think a big piece of this is bridging communication gaps. I think a lot of the regulations that come out, a lot of the innovators out there are wondering, how does this apply to my product or my service, right? And regulators can be very transparent in some ways. If you went on Google today, you could actually look up all the exam manuals that are out there, but they're also like 10 to 15 years old. And I think that it doesn't apply to a lot of things that we're seeing on a day-to-day basis. And policymakers are very focused on not just the letter of the law, but the intent of it, right? They don't want people to circumvent things just because there's a loophole in the rules. And so one of the things I saw when I was at the Fed was there just needs to be a lot more communication that has to happen with private sector. I think that when guidance comes out, it has to be a lot clearer about pragmatic examples and things that can help guide some of these innovators in terms of making the decisions that they're making on a day-to-day basis.
I'm glad you brought up communication and the compliance sort of side of things. Are there governments or specific regulators that you think are doing a good job doing that outreach to investors, to firms, to kind of bring them in and hear what they need?
Yeah, so when I was at the Fed, we did work quite a bit with the Monetary Authority of Singapore. And of course, a much smaller country, they've got a lot less fragmented regulatory environment. But what you saw out of them was almost embracing innovation and seeing it as a benefit, right? So they would do things like regulatory sandboxes, which you do see in other countries as well. They would actually have grants that they would make to companies that they felt were beneficial to the citizens of Singapore in terms of innovation. And they'd have a festival each year that's actually pretty well known and attended by globally. I think there's some lessons learned from that experience, right? Where I think in the US, again, it's a lot more fragmented, it's a lot more difficult, but it boils down to assuming that innovation can be a beneficial thing. Mm-hmm. And if that's the case, how do you harness it? How do you work with the folks in the ecosystem to promote innovation, but in sort of a safe and responsible way?
Do you think that assumption that innovation can be a good thing has taken a hit in the last year or so, as we've seen FTX's implosion, the crypto winter? Is there more wariness on the part of regulators?
I think so, and I think this always comes through as a pendulum swing in lots of ways. You'll have periods of time when regulators understand that they're not going to be able to be completely ahead of all these things, and I think that's more of a feature than a bug. And in those cases, things do maybe you'll see bursts of innovation and things happening that don't quite have a clear framework on how you regulate those things. And then I think with the FTX situation you're seeing, and not just FTX, but there's a whole set of case studies out there. And in fact, I'm in some bankruptcy claim because I had some funds that were sitting at Celsius, right? And now they're trying to figure out who gets the money back, right? So I think those are situations where they're very public, they're very much analyzed. And that's when regulators start to stiffen up, right? And I think sometimes the blame also gets allocated to them, and that creates just a natural kind of reactive mode that you're in, where you say, okay, we've got to figure out everything that's going on now, and we've got to be a lot more stricter about things that maybe in the past we didn't fully understand, and we kind of let continue to kind of run just to observe to see what happens.
Given that we're in Los Angeles, I've been thinking a bit about America and the backlash we've seen in recent years to big tech firms, and now that they're kind of trying to get into the fintech space. Do you think there are political risks there? We've seen Democrats and Republicans kind of wary of these big tech firms. How might that impact the ways in which they can navigate in the financial services sector?
Yeah, I think that's going to be a big. Upcoming sort of challenge that has to get solved, right? Because in the banking laws, there's always been rules that have sort of prevented large companies that are not banks to do banking things, right? Like you've seen in the past, companies like Walmart have tried to get an industrial loan charter, right, which would give them the opportunity to offer certain types of banking products, and that's been kind of really discouraged over time. And Walmart today does not have a banking charter. However, Walmart does have partnerships now with fintech companies, and they're offering products that are, similar to banking products. And I think they're going to continue to expand on that. There was a pretty well documented acquisition they did in the past couple of years, and they're working with companies in that space. And so there is going to be that question of this blurriness of what is, I think this is a prompt that we'll talk about later. What is fintech, right? But what is banking, right? And what role do these large tech companies have to play in that? And there's things that are outside of this around antitrust and so forth that I'm sure that a lot of politicians are going to be speaking to and trying to, potentially regulate, right, in some way.
And looking forward, what trends are you watching that you think may develop in sort of financial innovation in the way that it is regulated?
Yeah, I think what we're seeing, and my company is part of this, is that kind of blurriness of what's a bank, what's fundamentally the definition of a bank, and how does that coincide with what we're seeing in the market today, where you have a lot of companies that are partnering up with banks and doing banking things. And so I think from a regulatory standpoint, when I was at the Fed, we'd always talk about this concept of the regulatory perimeter, which is what's the jurisdiction, what are the things that regulators have control and insight over, and what are the things that are outside of that, right? And some people call that shadow banking, right? And I think that's going to be the topic moving forward in the US is how do regulators grapple these things that historically have been focused on, do you have a charter or not, right? Versus now you're seeing activities that may not be chartered, but they're in partnership with a banking charter that are still financial in nature. So how do you regulate those things? How do you make sure that, back to the premise of this conversation, that there's still innovation that allows us to grow and allows us to serve certain segments of the population, but how do you do that as well in a way that doesn't harm people?
Well, we could go all day, but I would love to open it up to audience questions if you have any.
Thank you so much for sharing. Loved what you said about shadow banking, and as we see, private credit is taking on more and more of a role of banking, whether it's in originating home mortgages or in the lower middle market. For all the reasons you talked about, with smaller regional banks, just can't be responsive. Do you think that the increased regulation on the state and federally chartered banks are going to make private credit increasingly competitive because they can do innovation because they're outside the standard regulatory structure, and thus we might be watching the end of the small regional bank and really the transition to dominance of non-bank banks?
Yeah, no, that's a great question. And it reminds me, actually, post-global financial crisis, I still remember going into a meeting or a session with a firm at the time. And this is when they were really small. They're a big proponent now of buy now, pay later, and they've kind of innovated on that. And that was one of the things they brought up early on is, hey, we've come up with this thing, it's consumer credit, and you can go on a vacation, and it turns out you don't have to pay it all at once, right? Isn't that great? And I think there was a question that came up, well, we just came out of this crisis and all had to do with mortgages. Is this a great idea to loosen up that credit in a different kind of space? And it created this debate, right? But I think, to your point, that non-bank private credit space has already grown significantly. When you look at even mortgages, I think one of the biggest mortgage lenders are no longer banks, they're non-banks, right? So I think you're going to continue to see that. What you've seen in reaction to that is that there are lots more state-level regulation when it comes to lending and consumer lending in particular. And the idea is who is the lender, right? There's this whole debate about true lender rules, right? And the idea is that many of these non-bank lenders do rely on some sort of bank, and in some cases even the charter of the bank, to do that lending. And so what regulators are trying to figure out is who should we regulate and how should we regulate it, right? And I think that over time, if they see that additional ballooning of private credit, to your point, there's going to be other ways that they're going to try to figure out how do we start to look at these things in a way that makes it more of an equitable, fair kind of competitive environment. Because otherwise, to your point, you're going to see more and more shadow banking, and that those things are in theory less regulated, right, than a bank.
Sure. Aaron Spalding, Spalding Financial. What are some of the ways that you see, like, explicitly values being improved by regulation in this space?
I think that there's a lot of areas where I think at least the dialogue and the beginnings of having the conversation is good. So as an example, one space that I've seen a lot of work around is earned wage access or early wage access. And this is the idea that if you have a paycheck and we know you're going to get the paycheck, can we get you the money earlier? All right, so let's pay you sooner than your 2-week basis, right? And there's a lot of companies out there that offer this type of product. And there's been always a question of interest rates. Are you charging interest in some way? Are there fees attached to it? Does this look like a payday loan, essentially, that could be abusive to the consumer? And there's gray areas of this. What we've seen is like companies say, hey, we'll allow someone to tip us. It's a zero interest thing, but we'll allow you to tip us. And if you tip us, then that's optional on your part, and it shouldn't be interest. But what you're saying is, well, it depends on how you phrase the tip and where you put it in the onboarding process in your app and how you word the language, where someone might unintentionally give you $5 on a $200 earned wage access, right? And if you calculate that out, if it's only 2 weeks, that becomes like a really big interest. So those are the types of things where I think there's no black and white sort of rules around, hey, this is interest, this is not interest. But I do think that having that conversation and having the regulators start to look at that space is ultimately positive than it is negative, right? And I think there's a lot more nuance and things that have to be worked out. But I think just letting folks do that without any sort of regulation or examination around those things is a net negative, in my opinion.
I think that's all we have time for this first part, but I want to thank Mitchell for coming up and doing this first part of the event.